Welcome to Business BTS, where we uncover the untold stories and dive deep into the behind the scenes of the world's most intriguing business case studies. Imagine waking up one morning as a startup founder, excited about your next big product launch. You check your bank balance, and bam! Your bank has collapsed overnight. This isn't a what-if scenario. It's exactly what happened with Silicon Valley Bank. Yes, the golden goose of startups, trusted by everyone, just went bankrupt in a blink. But how did it get here? And what does this mean for the future of startups? Let's break it down. Silicon Valley Bank, or SVB, wasn't just another bank. It was the financial backbone of Silicon Valley. From venture capital firms to high-flying startups, SVB catered to the tech elite. Imagine a bank that worked hand-in-hand with over 50% of the US venture-backed startups, managing billions in assets. You get the picture. It wasn't just about banking, it was about enabling innovation. Let's break down how they operated. SVB's business model focused on providing loans to startups and holding their deposits. Many of these startups were flush with cash after rounds of venture funding, and they parked that money at SVB. So far, so good, right? But here's where it starts getting tricky. Fun fact: at the time of its collapse, SVB was the 16th largest bank in the US, with over $200 billion in assets. It was a financial powerhouse, even if it wasn't a household name. Now, to understand why SVB collapsed, we need to rewind to 2020 and 2021. During these years, the economy was flooded with cash. Startups were raising money left and right. SVB, like any good bank, had a lot of deposits from these startups, but there was a problem. Banks don't just sit on cash, they invest it. SVB made a bet. They put a huge chunk of their deposits into long-term bonds. Why? Because bonds are supposed to be safe. But here's the catch. When interest rates rise, bond values fall. And boy, did interest rates rise. The Federal Reserve hiked rates aggressively to fight inflation in 2022. It's like buying an iPhone right before Apple announces a new model. You thought you got a good deal, but now the value of your old iPhone just plummeted. SVB's bond portfolio faced a similar fate. SVB now had billions locked in bonds that were worth far less than when they bought them. But that was just the start of their problems. Fast forward to early 2023. Startups, many of which were SVB's clients, were in trouble. With rising interest rates, venture capital funding slowed down, and startups began burning through their cash reserves. SVB needed to raise cash fast to meet withdrawal requests. So, they decided to sell some of their bonds, at a loss. This move spooked investors. A classic case of bad news travels fast. Panic started to spread. Major venture capital firms advised their portfolio companies to pull their money out of SVB. And that's where the real problem began, a good old-fashioned bank run. In just 2 days, customers tried to withdraw $42 billion. That's like trying to empty the ocean with a bucket. No bank can survive a run like that, and SVB was no exception. They simply didn't have the liquid cash to meet those demands.
We were advised to withdraw our funds immediately. The fear was real, and the tech world was on edge. It all happened so fast.
When SVB collapsed, it wasn't just a bank problem. It became a startup crisis. Many startups had all their funds with SVB. Imagine a tech company that suddenly can't access payroll, can't pay vendors, and can't operate because their cash is frozen. That's what happened to hundreds of companies overnight. Take Roku, for example. They had 26% of their cash, nearly $500 million, sitting in SVB accounts when the bank collapsed. That's not just some change you find under the couch. The collapse of SVB wasn't just a Silicon Valley story. It sent shockwaves through global markets. Investors panicked, fearing a larger banking crisis. Venture capital funding slowed down even further. Startups were in crisis mode, and tech stocks started to plummet. The stock market took a hit, and even international markets started feeling the pressure. Companies far removed from Silicon Valley were suddenly worried about whether their banks were next. It's like watching your favorite superhero fall in the first 10 minutes of the movie. Everyone suddenly starts wondering, wait, are we next? When the dust settled, it was clear that this wasn't just a Silicon Valley problem. It was a systemic issue. Enter the US government. The Federal Reserve, Treasury, and FDIC stepped in, guaranteeing that all depositors, yes, even those with more than the $250,000 insured limit, would get their money back. This fast intervention was necessary to prevent the tech sector from collapsing, but it raised eyebrows. Critics argued it was yet another bailout. Others pointed out that without this intervention, the tech industry might have ground to a halt. So, was it enough? In the short term, yes. But long term, it opened up new discussions about how banks like SVB are regulated and what kinds of risks they should be allowed to take. What does the future look like after the SVB collapse? Will it happen again? Well, one thing is for sure. Regulators will be paying closer attention to banks with heavy exposure to the tech industry. Risk management will need to improve, and startups might have to diversify where they park their cash. It's also a wake-up call for venture capitalists and founders. Having all your money in one bank, no matter how reliable it seems, is a risky move. So, what can we take away from this? A few key lessons. 1. Diversify your deposits. Don't keep all your cash in one bank. No matter how trusted, it's always good to spread the risk. 2. Risk management is key. Whether you're a startup or a bank, understanding the risks in your investments can save you from disaster. 3. Stay informed. Keep a close eye on the financial health of your bank. Sometimes the warning signs are there before the collapse. And for banks like SVB, they'll need to rethink their investment strategies, especially when dealing with industries as volatile as tech. The collapse of Silicon Valley Bank is more than just a cautionary tale. It's a defining moment for the tech and financial worlds. And it's forcing everyone, startups, investors, and regulators, to reconsider how they manage risk. What happens next? Only time will tell. But one thing's certain. The way we think about banking in the startup world has changed forever. Thanks for watching. Make sure to like, subscribe, and hit that notification bell for more behind-the-scenes business stories, only on Business BTS. See you in the next video.